Hi, Miranda. Dan Solin here.
Hi, it's great to talk to you. I really enjoyed this book. It's short, it's practical.
There's not much in it, but it's short, so it's good for most people.
Well, and it's practical.
Yeah, thank you.
And it makes a lot of sense.
Thanks.
So, so I kind of wanted to first of all ask. You talk about how it's the proven way to beat the pros and take control of your financial future. How is investing? How is that one way that you can take control of your financial future?
Well, first of all, I think the way people are currently investing, they have no control over their financial future. They're relying on brokers or advisors who are telling them things that just aren't true, like I can tell you when to get in and out of the markets. I can help you pick stocks that will outperform other stocks. I can pick mutual funds that will outperform other mutual funds. None of this is true. Nobody has this expertise. So you're just relying on people who are emperors with no clothes. $7 trillion has been lost as a consequence. What I'm saying to people is there is a proven, academically validated way to intelligently invest. It has nothing to do with using those people or relying on their advice.
And so what is this? I mean, you mentioned that no one should own individual stocks. Is that kind of your way of saying, you don't need the pros, you don't need stock pickers? What should people invest in if they shouldn't be investing in those stocks?
Sure. Well, actually, two questions. One is, why shouldn't people own individual stocks? Because the expected return of any individual stock is the exact same as the return of the index to which it belongs. So if you own Microsoft, it's likely that your return on Microsoft is going to be the same as the return on the S&P 500 index. But the problem with owning Microsoft is you have what's called idiosyncratic risk, which is risk associated with that one company, like something happens to Bill Gates or something happens to Microsoft, some other competitor takes it over. So by owning an individual stock, you take on twice as much risk for the same expected return. So instead of doing that, all investors have to do, and here's the good news, this is really simple and easy, but you're not going to hear it from your broker or advisor because they can't make any money telling you this. Determine your asset allocation. That's how much of my portfolio should be in stocks, how much should I be in bonds. You do it by taking a short asset allocation questionnaire. There are many on the net. There's one on my webpage, smartestinvestmentbook.com. Once you've made that determination, buy 2 low-cost index funds directly from Vanguard. You can use iShares that need to be purchased through a broker. You can use Fidelity. But the 2 funds I want you to buy are one that benchmarks the world's stock market returns, one that benchmarks the domestic bond returns. That's all you need to do. You now own a globally diversified portfolio of stocks and bonds. You're not trying to figure out what's going to outperform anything else. It's the simplest plan imaginable, and all the data over the last 20 years tells us that people who followed this simple, easy to implement plan would have returns 400% higher than people who are relying on market-beating brokers and advisors.
Okay, so then you mentioned these index funds and everything else. Does that actually still apply then in today's markets? How does that work when you're investing in a market that's kind of, well, not today's market, today it's up, but in a kind of a market that's really volatile right now?
It's a good question. It applies in all markets because when you take the asset allocation questionnaire, if the answer to one of the questions is, I'm going to need more than 20% of my assets in the next 5 years, what that asset allocation questionnaire is going to tell you is you should take no market risk, no stock market risk. You shouldn't be investing at all in the stock market. It's too risky for you because all we know about the markets is that over periods of time, long periods of time, they go up. That's all we know. But we've seen over short periods of time, they can drop precipitously, as in 2008. So it's always the right time to invest intelligently, but you have to be sure that you're in the right asset allocation so you can tolerate short-term volatility.
Okay, so then what would you do? What about like right now with people who are looking at retirement, maybe from last year to the next 5 years? Right now, they're having a hard time getting their assets in order because is they've lost so much of their portfolio. What can they do to kind of get back on track and try and save their retirement?
Well, it's unfortunately, you have to really feel for people who are retiring around now because it's the perfect storm for them. We know that the most important factor of whether or not people will run out of money is how much money they start with. So now we have so many people who lost so much money that it seems unlikely that they're going to be able to sustain their quality of life in retirement. So those people have to basically defer retiring. They have to wait 2 to 3 years if possible. The data tells us that if you wait just 2 or 3 years, if you can defer retiring for 2 or 3 years, you can actually increase your retirement nest egg by as much as 25%. So retirees, like everybody else, have to have the right asset allocation. They should have a portfolio that is primarily in bonds with fairly minimal exposure to stocks because they can't replace those losses and they need income. But unfortunately, they just don't have enough money to retire, so there's not that much we can do for people. Their timing was terrible through no fault of their own. Many of them were taking far too much risk because their brokers and advisors, many of them, don't know how to measure risk and had them in portfolios that were unsuitable for them.
So then you mentioned just now and also in the book that the brokers don't know how to measure risk. How is it that you can measure risk for yourself as an investor?
Well, if you take an asset allocation questionnaire, it'll tell you what the division of your stocks, your portfolio between stocks and bonds is, and that's really what determines your risk. That determines what's called the standard deviation of your portfolio, which will show you how volatile your portfolio is. So most individual investors are not going to be capable of running the calculation that shows standard deviation, but we can still protect them by ensuring that they're in the right asset allocation, because that's what determines risk. More bonds, less risk. More stocks, more risk.
Okay. And then finally, I was just kind of wondering, you mentioned in here avoiding brokers and selecting investments directly from companies like Vanguard and Fidelity. Would you recommend also against like online brokers, discount brokers, or do you think that that's kind of an exception?
Well, I think discount brokers have pluses and minuses. If you're buying the 2 low-cost index funds that are exchange-traded funds that I'm recommending, you need a broker, and therefore I would recommend that you use a low-cost discount broker because costs are very important. The problem I have with discount brokers is that they encourage people to trade, and trading is hazardous to your financial wealth and health. So discount brokers say, look at all of our research, we'll help you buy this, we'll help you sell that, because they make money on trading commissions. But if you use them judiciously and buy only the low-cost index funds that I'm recommending, if you have to go through a broker, you want to use the cheapest broker to keep your costs as low as possible.
Okay. All right. Well, do you have any other investment tips for my readers?
Well, my basic investment tip would be if I could wear a button that said, those no smoking buttons, and it said no brokers. It would then also say no actively managed funds. Don't buy any funds where the manager says, oh, I can beat the benchmark. 95% of all actively managed funds underperform their benchmark over a 10-year period. Stick to low-cost index funds.
Okay. All right. Well, thank you so much for speaking with me today.
It was my pleasure. Thank you.
You have a good day.
Thank you, you too.
Thanks.